My name is Omar Erlingsson. I'm in infrastructure security. I'm here to present the speaker for today's special talk in the Authors at Google series. So our speaker is Gudrun Johnsen, who is a statistician and economist from University of Michigan, Ann Arbor. And she has worked for the Icelandic Parliamentary Special Investigation Commission on investigating the causes of the economic collapse that happened in Iceland in 2008. So for me, it's sort of quite a personal subject. I'm originally from Iceland. My family and I moved there in 2007 from here in Silicon Valley, where I've been working until then. And on a trip back, one of my colleagues asked me about sort of what were the underpinnings of the Icelandic economy. And I knew that there was a lot of fish. That's what had been there when I was growing up. And I knew that there was a lot of banking. And I didn't exactly know what. There was some financing, banking, stocks, and so on. And very soon after that, it all came down with a bang. 95% of the market value of the stock market vanished overnight. 3 of the 6 largest bankruptcies in world history are Icelandic banks. So quite a large sort of turn of events. As it turned out, what really had been behind all of this and this great rapid rise in the banks seems to be all kinds of different shenanigans. And so Gudrun is here to tell us about those shenanigans, which, because Iceland is relatively small, and because of this completely unprecedented special commission set up by the parliament, which had basically total powers of investigative authority, able to see all data everywhere with no exceptions, we actually know what happened there. But I think in a sort of greater context, most of us have just moved to Iceland. And there's a lot of stuff that's going on that in world finance and so on that is quite reminiscent of the shenanigans that were happening there a few years ago. And I don't think fundamentally very much has changed. So anyway, with those words, I'll give the word over to Gudrun.
Thank you, Ulvar. Thank you so much, and a special thanks to Ulvar for inviting me here and organizing this event. It's a great opportunity for me to be here with you. I have been giving this talk mostly at financial institutions and government agencies, but I wrote this book, Bringing Down the Banking System, as a sort of wrapping up the 2,400-page report that we issued and nobody read, into manageable size of 200 pages. But I wrote it for non-financial or non-financiers, let's say, if there's such a word. So it's great to finally be in front of my targeted audience. Now, as Ulvar mentioned briefly, 97% of the Icelandic banking sector collapsed in October 2008. And before we entered into the investigation at the Special Investigation Commission, where I was actually the first employee to be hired by the commission, so I was there from day one and until the minute it was published in 2012. We sort of had an idea why this happened. But obviously that wasn't enough for the Icelandic public to be told that was a result of a rapid growth of credit and size of the banking balance sheets to GDP and inadequate financial supervision. I mean, that's the short elevator story. But we needed to tell them how exactly this is possible and how do you do this. Expanding your banking sector from being about 1 times GDP to 10 times GDP at the peak. We also needed to tell them why would you ever want to do this, given the risk that this is a really risky strategy. So why would you ever want to do this? The third question we had to answer was, why on earth didn't anybody stop this development? And finally, in my book, I tried to sort of bring forward to the rest of the financial world what we can learn from this calamity. Now, I will ask you to jot down your questions. We're going to save the best for last, your questions. So I'm going to, it's quite a lot of material. It demands quite a bit from the audience. So I'll ask you to wait with your questions until at the very end, unless something is horribly vague or confusing. Now, very briefly on the SIC, it was installed by Parliament, and there were 3 people appointed by the Parliament to sit on the Commission. It was a Supreme Court Justice, Páll Hreinsson, Sigrid Benediktsdóttir, who was a lecturer at the Economics Department at Yale University at the time, and another lawyer, Tryggvi Guðnason, who's an Alþingis ombudsman. Alþingi is the Icelandic Parliament. Now, the mandate was not of any insignificance. It was to seek the truth, no less, behind the events leading up to the fall of the Icelandic banks. And what was also quite challenging in a small society, and bear this in mind throughout the lecture, Iceland is a large country, but relatively large, but we are only 330,000 roughly who live there. So somebody told me half of Frankfurt. That struck me as a quite a good benchmark. Now, the challenging part was to basically find out whether mistakes or negligence had occurred in the course of the implementation of the laws and other rules regulating or providing control for the financial market. And in addition, what persons may be responsible. Now, the separation of degrees, the degrees of separation in Iceland is obviously 1 or 2. So this is a delicate matter. This was a privilege to actually be involved with this effort, simply because the Icelandic Parliament thought that it would be impossible to deliver proper investigation without full access to all data necessary, that the Commission deemed necessary to deliver on their mission. Now, we basically had powers to search all premises, seize evidence considered necessary for the purpose of its investigation, subpoena witnesses, and in return we were to report any suspicious conduct to the special prosecutor, who is still working on cases brought about as a result of this investigation and other. Final product was a 2,400-page report published 12th of April 2010. And the task was quite big. We did not, like the Lehman examiner's report, is also 2,400 pages. We'll go over that soon. But just to tell you sort of the scope of the research was the 3rd largest bankruptcy in history. And we had to go into 3 banks, not only one, and all surveillance authorities involved with oversight of the financial sector. In addition, a special request from Parliament was to investigate the cross-ownership of Icelandic firms. And I think there the biggest contribution to the rest of the world of finance lies. This analysis into the cross-ownership of Icelandic firms. Now, we were 48 people, we're again 330,000 people living in Iceland, and it was quite remarkable that we were able to find people who were not conflicted in any way. Many of them had been living here in the States. Most of them had done research, were PhDs from here in the States, Yale, Stanford, and elsewhere. So basically, with all this data, we collected data from the entire financial market, funding of the banks, all loan portfolios of the banks, so every single loan, including Visa statements, the salary data, And also what I'm particularly proud of, we gathered data from the stock market and down to basically individual investors on both sides of the trade. So, this is a high-frequency data set. In addition to the data I mentioned before, we also received the entire registry of enterprises in Iceland. And that was essential to be able to drill down the cross-ownership of firms. Now, just for sake of comparison, the cost of the investigation, you can find the whole report on this. There are selected chapters translated in English. 2,400 pages, 800 pages supplement online. It took us 15 months, and the cost was $2.5 million US. Now, the examiner report on the fall of Lehman Brothers is also available online. It is 2,200 pages. It took them 15 months to get it done. The cost was 38 million plus US dollars. So you can see that you can get experts from Iceland on the cheap. Now, to start answering the questions I proposed in the beginning, how did this happen? At the early start, funding was easy, and basically the bankers went into the European medium-term note market and received about 35 billion euros worth of bond issues.
I'm sorry, the European what market?
So European medium-term note market. That is a standardized bond issuance program. So you see here that the columns here show that the European market had a big appetite for the Icelandic bonds in 2005. It dropped somewhat in 2006, and you see what opened up. That was the US medium-term note market that opened up for the Icelandic banks, simply because of this very nice feature. They had a stellar credit rating that was largely inherited by the Icelandic state, which was virtually debt-free at the time. But they were also willing to pay high interest rates at the level of other emerging market institutions with lower credit rating. Now, it was as if they didn't really think this through. The appetite for issuing bonds was enormous, but they were bond issues for 3 to 5 year maturity. And in fact, the first big payment was too big for them to deliver on. So in October 2008, Glitnir Bank went to the Central Bank of Iceland and basically said that they wouldn't be able to meet this payment and asked for a loan of last resort. And from then on, things started to unravel quickly. Now, the terms were good in the beginning as credit rating went through the roof. In 2007, they received the highest grade, top of the class, AAA rating from Moody's, which Moody's corrected in a couple of months. Moody's thought that they would be, these banks were simply too big to fail and would be bailed out at whatever, in whichever circumstances, but failed to recognize that the banks had already exceeded the GDP, everything we produce in Iceland, 10 times. So we would never be able to bail those banks out. Now, as you see here, it's a nice, here at Google, first thing you do is to plot your data. And here you see Kaupthing 5-year bond issues. At the beginning, they are issuing 1 billion euros at a time, at a rate around 20 to 30, and it rapidly grows. Here are some peculiar outliers. Somebody is accepting much lower rate than the market is. Now, we did receive our warning. In 2006, market analysts started to point out that this rapid growth of the balance sheets of the banks was unsustainable. And both, primarily Danske Bank came up with this very nice term for it, the geyser crisis. And it fitted this episode very well because the CDS spreads, the credit default spreads, they kind of blew up but settled down quickly again at a lower level. But that did not measure up to what was to happen later on when the big blue mountain blew up and we had CDS spreads going through the 1,000 mark. Both Icelandic bankers and officials alike sort of dismissed this market signal completely, and they claimed that it was the CDS market was marked by collusion, ignorance, it was a thin market, and so on and so forth. And it is just as if they didn't really know what they were talking about, or they didn't really look, because when the banks failed, there were $70 billion outstanding contracts, CDS contracts on those three banks. And again, comparing to Lehman, outstanding CDS contracts on Lehman were 72 billion. So it was by no means an illiquid market in that sense. Of course, it's a market with insurance, so it's not going to behave like stock markets, right? Now, being faced with such a high cost of funding, the banks simply had to turn elsewhere to refund the banks. And where did they go? They went into two directions. One was to go to the supremely informed central banks, and they managed to borrow the equivalent of 9 billion euros at the very height. Again, comparing to the financial rescue package that Iceland received from the IMF and the rest of Scandinavia was about 3.5 billion euros. So significant amount of money they borrowed from the central banks. And how did they manage to do that? Well, they backed it with bank bonds to a large degree. Here you can see the collateralized lending from the Central Bank of Iceland. This is denominated in ISK. So you can see basically how dependent they are of this short-term fine-tuning funding facility from the central bank. So for 3 years, they're completely dependent here on the 100 billion. At the time was roughly half of the budget of the Icelandic state.
What's the conversion factor for the currency?
Say again?
What's the conversion factor?
So you can roughly 100.
Okay.
Now they backed it with government secured bonds, but also with fellow bank bonds, and that they did at an increasing rate. The central bank acknowledged that these collateralized lending was getting excessive, so they tried to stem the funding to the three banks, but the bankers really didn't stop at that. So they asked a rival small cooperative bank to aid them in the process of virtually printing money out of the Icelandic central bank. So what they did was they issued new bonds, fresh bonds at a certain interest term, and then they turned to the rival bank, which received the bank bonds, which then again turned to the Central Bank of Iceland to get liquidity out of the Central Bank of Iceland. Now this is, and the bankers reported it to the Special Investigation Commission that this was a stunt that they played and had learned about from other European bankers, which is a little bit worrying, obviously. Now, they did try to play the same trick on the European Central Bank. They placed bonds as collateral against loans from the Central Bank, European Central Bank. But you see how they pick up on it in May, and the story goes that the ECB basically directed their demands towards the governors of the Central Bank of Iceland to have the bankers take this out. realizing that they were swapping bonds. There was no original investor backing them at the outset, and after a while, they basically disappeared from the books as collaterals of the ECB. Now, what they did though, and the amounts were quite steep. 4.5 billion euros they received at the very top from the European Central Bank. So after having been asked to take out the Icelandic bank bonds, well, they replaced them with CLOs and CDOs that had ISK assets among them. So collateral in ISK and the Icelandic krona against a loan in euros is not a good collateral at all. So there's a whole story about that. And the Icelandic Central Bank, in fact, bought these CLOs from the European Central Bank in the year 2010. And the European Central Bank reported that it did not lose anything on the deals with the Icelandic banks. That was not the same story with the Icelandic Central Bank, which virtually became bankrupt as a result of receiving collaterals that they couldn't collect after the banks had gone over. Back to the growth, and I know I'm cheating here a little bit. I'm showing you here nominal growth, but it was reported nominal growth 20-fold in 7 years. So I prior to getting involved with the Special Investigation Commission, I was working for the IMF, where we were studying rapid credit growth, and I can tell you that there's very hard to find. It's impossible to find data that would show you larger growth of any banking sector. Now, the sort of obviously when you see banks grow this fast, some people get worried. They know that institutional structure or institutional capacity does not really support this growth. People cannot extend credit at this fast a pace and ensuring that all relevant documents have been collected and the credit scoring has been proper. So So the bankers basically pointed out that after receiving this criticism that they were growing too fast, well, we are diversifying. We are getting outside of Iceland, acquiring new institutions, new banks, new endeavors. But when we looked at this and tried to verify this statement, we saw that not only was the acquisition growth large, but the organic growth was also quite large, and another world record, basically. We saw the banks grow 50%, 60%, 35%. This is phenomenal. So it surely was a strain on the institutional infrastructure. Now, then you got to ask yourself again, with the 330,000 people, all this money coming in, what did they do with the money? The commission basically was able to, although the data was a little bit difficult there, background variables weren't properly collected, but there are features in the identification number or social security number in Iceland that aided us in categorizing the loans that had been extended. And we found out that about 60% of the loan books were to foreign entities, so implying diversification, and to holding companies in 2007. But after a good cooperation with Luxembourgian authorities, because we didn't obviously have the same data privileges in the UK or Luxembourg or elsewhere where the Icelandic banks had operations, we did not have any access to data from the subsidiaries. The Luxembourgian authorities supplied us with two data points. where we could see that the majority of the loan books of the subsidiaries were also somehow connected to ISK risk. So sort of dismissing this statement that the growth was primarily outside of the country and hence a diversification. Now, back to that small population, you gotta wonder, how is it possible to extend such an amount of credit given the legal constraint that one banking institution can only extend about 25% of its equity base towards a group of related parties. Now, we think we know how you do that, and this is basically how you do that. This is the cross-ownership of firms in Iceland. The red dots represent each firm, and there are some ownership connections to the next dot, but these are only large firms in Iceland. So half a let's say 500 million ISK, so $5 million US roughly, is the balance sheet of each and every firm here. You see where the nodes lead. These nodes are the banks themselves. So this is the interconnectedness of the Icelandic economy before the collapse. Then our task was to assess who are the related parties according to the definition of the law. And using an algorithm and this network analysis, we were able to assess, or rather, come up with a unbiased methodology to actually find out who were connected. And here you see just two random examples. And what was also a little bit scary to see is the circular events that you see. Here is a firm A that owns firm B, that owns firm C, that owns firm A. So under these circumstances, virtually no equity, no skin is put in the game. So one of the lessons is that if we don't properly analyze ownership or ownership ties or interconnectedness in our system, we know that agents that play this game simply have, the sky is the limit. So there's really no limit to how much risk they're willing to take because they are not risking their own money at all. Now, after we had identified the related parties, we then merged them to the portfolios of the banks, the loan portfolios. And lo and behold, we found out that the borrowers were to a large extent the owners of the banks. It varied a little bit in levels, how much access they had to their bank. But here, this particular group, Baugur Group, received the equivalent of about 80% of the equity base of Glitnir, where they were controlling shareholders. So here you see the legal limit is 25. They exceeded it throughout the time. Now, here's their business partner, who also gained a controlling stake at the bank at some point. Somebody wants to venture a guess when that happened? So yeah, it's right here, in June 2007. So as I say, it was the same pattern in all three banks. Here, Björgólfur Guðmundsson, one of the controlling stakeholders, exceeded the 25% threshold throughout the period, out of the 4-year period we had data for. And the same goes for Exista, controlling stakeholder in Kaupthing Bank, again dancing along the line throughout the period. Now, obviously, the loan portfolios were marked by excessive risk, and the next task was to see the payment structure of these loans. And that was also quite shocking to discover that not only had they been extended to holding companies that were tied to the owners to a large degree, but also they were not paying anything off the loans. They were not paying interest rates, and they were not paying off any of the loan during the lifetime of the loan. So bullet loans became the largest share of the portfolios. Then you wonder, what type of collateral are these borrowers putting forward? And that really matters. Because we had this beautiful data privilege and this data set from the stock market, we could basically, we had also access to the banks, so we could see what was inside of the custodian accounts of the banks, because that's an old trick in the book to have your bank hold the stocks that you are pledged. So your ownership is not disclosed at all. But so what did they pledge? Basically, to a large degree, the banks had received a collateral in the form of listed stocks in Iceland. There's a caveat here because the data quality on collateral was incredibly poor. So this was really the only only comprehensive data that we could receive as in terms of collateral. So this is a little bit misrepresentative here, but still, we saw that, for example, FL Group was an investment boutique or investment closed-end fund, in fact, and about 70% of all outstanding shares in this firm were pledged into the banking sector. To our horror, though, we saw that about 40% of Kaupthing was pledged into Kaupthing as collateral or as treasury stocks. Now that is illegal. You are only allowed, according to Icelandic law, to hold 10% of treasury stocks. This is illegal in the States. You cannot help. At least if you do have treasury stocks, you need to deduct them from your equity base. It's money that hasn't been paid into the firm, or equity that hasn't been paid into the firm. The following question, after having discovered this, we had to ask ourselves, how did they behave in the stock market then? I mean, now that they were dependent on collaterals from the stock market. And lo and behold, we saw a certain pattern there as well. Here you see Kaupthing trading in own shares, and Kaupthing is buying above zero, and they are selling below zero. And the blue line here represents the price of the stock market, of the share price, of the Kaupthing stocks. And it jumps out of the picture that this is not symmetric. So they are buying close to 60% of the volume of all trades in Kaupthing. They are on the buying side at the very end. But what are they doing in terms of selling? They're not selling anything. So what were they then doing? What type of business was this? What we figured out was that they were primarily, you see the blue columns here, they are above zero, so they are being bought on the stock exchange, but Kaupthing is selling over the counter. Now, one of my favorite pictures in the whole 2,400 pages is right here. It represents the level of leverage in the Icelandic stock exchange. So how much, it's a delta, so how much are we increasing in terms of taking collateral in the form of listed shares? And as long as you are receiving more and more collateral in the firm, or you're accepting more and more collateral in the form of stocks, they are buying on the margin more and more. You see that the price is rising. And as soon as the red line there leveling out, as soon as you stop accepting listed shares as collateral, the price drops like a stone. So this is virtually a picture of an asset price bubble. Now,
why were they buying on the market and selling OTC? What was the purpose? Was that to manipulate the price on the exchange?
Basically, yeah, we will come to. Why were they buying all these shares in themselves? basically they had become quite dependent on the share price. And we will see it on the next slide, which added to their demise, is that the largest controlling stakeholders had also borrowed money from the big investment houses in the US. So Citigroup, Morgan Stanley and those. And they had pledged the Icelandic stocks in the Icelandic banks as collateral against these international loans. Now, after the stock market had started to decline, the Americans basically called on the margin. And what the bankers in Iceland decided then, well, we can't allow this to happen because they will go into the market and sell those shares. And what will happen with our pool of collaterals, it will decline. So they decide to chip in and pay the margin calls and refund those shares that were in themselves, accepting their own shares as collateral. So basically a year before the banks finally collapsed, they had become so dependent on their own stock prices that they decide to bet for life and take over this collateral that is no collateral if they themselves go under. Which then again, this would have been fine if they had deducted the shares that they took as collaterals from the equity base, but they kind of forgot about that. So if we take that into account, and here you see, if we only take that into account, the capital adequacy ratio that they reported was misreported, basically. And here you see Glitnir, it's in fact close to the legal limit, which is 8%, a year before the banks collapsed. The bank collapsed. For Landsbanki, it had already gone below the 8% limit. So there, the Financial Supervisory Authority should have stepped in and taken over the operations. And if you count cross-financing, financing of the rivals, in fact, 22% of the equity is basically funded this way, and 36%, 33% in 2008. So a third of the equity was basically not there. And in my mind, that is falsification of equity. But the report goes the route that claiming that this is weak equity that cannot be drawn on in the case of bankruptcy. Now, you gotta start wondering why people do this. And the short answer is they became rich. Here you see the incentive schemes pushed for excessive risk-taking. And just as a very small evidence of that is that here you see the total share of base salary of total pay in 2004 in Landsbanki. Here's the 99th percentile, so the CEO is placed here, and the key personnel. They received about 40% in base salary in 2004. In 2007, it's below 10%. So economists, we have sympathy towards the decision-making process that happens there. One, if you're not going to meet your bonus target, you're going to reduce your consumption by 90%. No, there's a very strong incentive to start manipulating a little bit or extending that evergreening loans and so on and so forth, rolling over loans, so that the picture looks a bit more rosy to meet the targets. And that is exactly what happened. There's enough material for a separate talk on the incentive schemes themselves, but in short, whether intentional or not, the management of the banks used staff as vehicles to falsify equity. In Landsbanki, for example, stock options were issued one day, not as a bargaining tool in salary negotiations, but one day we have a record of within Landsbanki where staffers were called up and said, "Hey, you've got an option grant now. Please come up and sign." And the logic behind, or rather the management decided to hedge those options So basically, in the beginning, they lent money into SPVs in Cayman Islands and offshore, lent money to have the SPV go into the market to buy the stocks and hold them until the options were vested or they were exercised. Now, this is a rather unusual and unnecessary hedge. We can, as I say, we can go into depth here, but in short, obviously the management decides on the timing on when to go into the market and buy those shares. And what happens when you inject into the market billions of ISK buying stocks in Landsbanki? Well, the price will go up, of course, and the options will be in the money immediately. Kaupthing started out with this, but they faded out their option program, and instead they had their staff borrow money from the bank to go themselves into the stock market and buy the shares. The shares were a collateral in that loan deal, and therefore should have been deducted from the equity base. Now, back to the funding side. The banks were experiencing incredibly high prices on funding or terms in the bond markets. So apart from going to the central banks, they went into the streets of London and Amsterdam to get money through deposit collection. And here you can see the total debt of Landsbanki. It changes rapidly. There are loans and deposits become the largest share of the funding structure. Now, as it is very risky to extend credit out rapidly, it is also very risky to collect deposits very rapidly. And they tend to be not so loyal. And how were they ever able to attract all these 300,000 depositors in the UK in less than 6 months? They basically offered the highest rate. And just through, I'm sorry for you're not supposed to scrutinize this regression analysis. This is very crude, but you see that there's not very much variation here. But this is basically, we saw that if Landsbanki reached the first place as highest deposit rates, they attracted about 18 million on average a week into the accounts. But if they dropped down to 5th place, they lost 16 million. So these were not very sticky. It's very volatile funding. And here is a picture of basically a run on a bank that happened here in the early of 2008. There's a whole story behind that I will leave my book to tell you.
Are they able to pay those high rates by attracting future customers?
So the question is, are they able to pay those high rates? Well, at the end of the day, no, of course not. They were run upon before as they were collecting, they paid the interest rates, yes, but it was not sustainable model as it turned out.
Like a pyramid scheme thing where by offering high rates, we'll get a lot of more customers, and we can use their deposits to pay the high rates to pay these guys.
So is it like a Ponzi scheme where you are giving out the high rates as you have the program open, and then you just disappear? Yeah, well, it was not intended like that, but that is the effect of it. Now, in the as you can see here, here's a run on IceSave in April 2008, and at the time, the management of Landsbanki reported it to the Central Bank of Iceland that with this outflow, they would survive for 6 more days. The Icelandic governors of the Central Bank of Iceland then reported that to the government, to the Prime Minister and the Foreign Minister. And there was really no action to this news, or no reaction to this news. IceSave has been the largest foreign dispute Iceland has had since the Cold Wars. And this is an ongoing saga, and it hasn't been fully resolved. Although the EFTA court ruled on whether the Icelandic state was liable for the deposits or should pay out the deposit insurance amount to the foreign depositors. The court ruled in favor of Iceland, basically. So we have figured out where the liability lies with the state or with an insurance fund that has been set up. And in fact, in this case, the insurance fund is liable. Now, as Lehman Brothers failed, obviously that proved to be an accelerator in terms of deciding the fates of the Icelandic banks. After the collapse of Lehman, the collaterals that had been pledged against loans to the ECB, from the ECB, they fell sharply. So the ECB started to call on the margin. Also, the depositors in the UK and the Netherlands became uneasy. So they started to withdraw their funds from the accounts. And essentially, the bank, Landsbanki, was run upon. Since they had collected the ISAVE deposits into a branch, which was under the supervision of the Icelandic Financial Supervisory Authority, the Brits had no means to step in, or very little means to step in. They knew that Landsbanki was not meeting its requirements, the liquidity requirements, because the money was just rolling out. So they found no other option except for intervening through a legal act that has become very controversial in Iceland, the so-called Terrorist Act, whose name is, in fact, Anti-Terrorism, Crime and Security Act of 2001. So the deposits of Landsbanki were moved out of Landsbanki, and basically the fate of the bank was therefore decided, or they had met their fate, let's say. But we know now that the bank really had little chance, or the banks had little chance, both because they were so interconnected and they had not enough equity to sort of as a buffer to see any of their assets go down in value. Now, basically, Kaupthing met the same fate a day later. The story is a little bit different there because Kaupthing adds where they were collecting deposits from the UK residents and elsewhere was done through a subsidiary, and this is one of the lessons of the Icelandic episode, is the difference between a subsidiary and branch, and who is responsible for the financial oversight. Now, the Brits were responsible for the oversight in this case. And after Northern Rock had failed, first bank in 150 years or so to fail in the UK, the supervisory authority became quite worried that there might be other vulnerabilities in their system. And what they spotted immediately were the Icelandic banks. And the deposit insurance was basically the deposit insurance fund was underfunded. So the British depositors acknowledged that in case of failure, it would be difficult for them to reclaim the money. So in all of the circumstances, and obviously bear in mind that Lehman had just failed, they had seen, the British had seen some movement of funds out of the UK over to the US just prior to the collapse of Lehman. The British authorities basically set up a very stringent liquidity rule against Kaupthing, saying 95% of those deposits that you are collecting through Kaupthing Edge, we need you to put them into liquid funds, into treasuries and papers that can be converted into cash very quickly. So with this rule, they should not have been able, the Kaupthing management should not have been able to use it for their own good. But in fact, they managed to trick the Financial Supervisory Authority in the UK for a while, because they engaged in a liquidity swap between the parent company and the subsidiary. So in essence, they counted the money 2 or 3 times. So the first time around, it was counted as liquid money. The second time around, it was just their funds, which they could do whatever with, and including sending it up to Iceland for the parent company to meet their margins or pay off their bonds and so on and so forth. And that is exactly what happened. Now, on top of this, so there were 1.1 billion pounds sterling engaged in this, so missing from the liquidity pool of Kaupthing. But on top of that, the collateral that they had pledged to the subsidiary for lending from the daughter company declined in value, but the subsidiary was irrespectively willing to extend the credit lines by 500 million pounds without taking any collateral. And this the British interpreted as siphoning money up through the chain of firms and up to the parent company. And as a result, having waited for the management of Kaupthing to react, the British authorities deemed it necessary to take over the Kaupthing Edge deposits and move them into ING and withdraw the bank license from the KSF. So a similar fate, slightly different story. Back to Iceland, the debt-free state. In early 2008, suggestions were being made to the Icelandic authorities that it should turn to the IMF for help. That was after the Central Bank of Iceland had tried to get credit or foreign exchange swaps with central banks in Europe and even here in America without success. And that is a signal that is fairly decisive. A debt-free state unable to get any credit anywhere. That should tell you something about the situation. The only takers in the FX swap market were the Scandinavian central banks, who in turn put forward very strict conditions in exchange for the money swapped. And the conditions were at a microeconomic management level, such as the central negotiating wage or centrally negotiated wages cannot increase in real terms. The Icelandic state cannot take on any further debt whatsoever. So this is a very invasive type of debt covenants, if you will. And as it turned out, very few people knew about it in Iceland. And the Prime Minister did not even disclose this information to the entire cabinet. And as a result, he got indicted and brought before the special court in Iceland that rules on breaches on part of ministers in Iceland, Landsdómur it's called. So for the first time in 100 years history of that court, the case was brought against him. Now you know how all this happened and why it happened. So the next question is, why didn't anybody stop this development? And the short answer is, it was too rapid of a credit growth. And there were too few people to handle all of this. Or rather, the main cause here is basically the politicians didn't acknowledge the need for strong supervision. If you're gonna build your economic system on the pillars of a financial institutions being one of the main industries of the economy, well, you need to have something to back it up, or something to a strong oversight. And there the policymakers basically failed in Iceland. So we had the financial supervisory authorities doing financial oversight of something that was 10 times the GDP of Iceland with only 36 employees. And for a trained statistician such as myself, it was a shock to observe that no proper data analysis equipment were used. Data was gathered in Excel sheets of 47 sheets from each and every institution, hundreds of small and large financial institutions in Iceland, and this was the data archiving and collection. So it's impossible to have an oversight under these circumstances. So, financial supervisory authorities, in short, there were lack of experience and incompetence, lack of proper IT systems, tool and processes for data analysis weren't in place. There was lack of authority, and follow-up cases were kept too informal for too long. Violations of the law went unnoticed, and law was not enforced. Now, the Central Bank of Iceland did have some more insight into the risk, but and also a legal obligation to ensure financial stability in the country. It, however, never formally nor informally conveyed it to the government what needed to be done to avert the risk. And had it thought that they lacked the legal means to do so, they did not report that either to the government. Now, there were a host of tools in the policy toolbox that could have been used, but were in fact not. So one of the lessons, and he put it very nicely out, Þórarinn Pétursson, senior economist at the Central Bank, the state of affairs in Iceland at the time. I think there is a fundamental misunderstanding of what financial supervision is all about here in Iceland, not only at the FME, the financial supervisory authorities, but also the central bank. They thought that the role of these institutions was to follow upon whether the letter of the law was met by those under supervision. So you are watching an entire financial system falling off a cliff, and as long as you are following the law, you're fine. So one of the recommendations of the Turner Review in Britain, which was issued after their crisis, is that the regulatory and supervisory coverage should follow the principle of economic substance and not the legal form. Just to inform you of the losses that were incurred after the collapse, about 5 times GDP was written off in a matter of 4 or 5 months after the system collapsed. And the findings of this delicate findings, or the challenges that we were faced in the beginning, the Special Investigation Commission ruled that on the mandate, on the mistakes or negligence by ministers and public officials in the period leading up to the collapse of the banks, the SIC is in the opinion that the Prime Minister, the Minister of Finance, the Minister of Business Affairs, Director General of the FME, governors of the Central Bank of Iceland showed negligence within the meaning of Article 1 of the law on the Special Investigation Commission. And as I told you before, the Prime Minister was found guilty on 1 count out of 4 of negligence by a special court Landsdómur. Now, fraud or failure on part of the bankers is still being decided. Some of them have already received their sentence on a regional level or a local court. Management of Kaupthing has been sentenced to 3 to 5 years in prison for fraudulent lending practices and market manipulation. They have appealed. Cases are pending against the Landsbanki management for fraud and market manipulation. And Lárus Velding, CEO of Glitnir, was found guilty but acquitted by the Supreme Court. Several other cases are pending against him. The special prosecutor has had over 200 cases in total. 58 are currently under investigation. There are 20 indictments, 15 already brought to court, and 8 cases have been ruled upon against 46 individuals. So this is already exceeding your legal efforts or prosecutional efforts looking into the savings and loans crisis in the 80s. Now, what can we learn? My husband is a human factors engineer, and he has taught me how So the human mind perceives things inadequately. And one of the things is that we seem not to be able to sense acceleration. We all know the story when we are going over the speed limit and we withdraw to the legal limit, we find that we are not moving at all. Taking this into account, you don't put anybody at the seat of the F-18, is it? 18, 19, 16, thank you. Unless he or she has several thousand hours in the air. So banks are like monstrous machines. So you need people that have the proper training and the proper insight, and also at the realm of the financial supervisory authorities. So that said, it is very, very important that, as you do here so well in America, acknowledging the efforts that go into further education, and you put people, well, yeah, that's the aim, to put the right people at the right spot. But another lesson is that the importance of equity. These monstrous institutions, the banks, are running at a very low equity ratio. So there's not much room for their assets to move downwards at all. This is one thing. I mean, now in Iceland we have banks that are set up or have a funding mix of up to 25% equity. And it's just that incentives are become very risky, let's say, or people engage in risky activities, and it all depends on how they are incentivized. So if you have your own money in an enterprise, you behave very differently from where you have no money of your own in the operation. Another lesson is that bankers need to understand that when they are lending money into holding companies, they have a claim on the residual claim. So the structures that I showed you should theoretically not be possible to construct, simply because if you take into account that you, the bank, you are lending the money for the equity part, you should price it accordingly. So there should be no money left on the table for the constructors of these structures. So pricing obviously failed enormously in the Icelandic banks. Supervision should be built on economic substance. We should try to have our legal framework set up in a way that it supports prudential policies that need to be adjusted quickly. The letter of the law is obviously fairly sticky. It's difficult to change in a short period of time. The medium-term effects in Iceland, we had massive market manipulation on our hands. People were not following the legal letter. They were evading the rules and the law. So as a result, we have a clear case where the markets break down. They just disappear. And that is what happened. The bond market was virtually non-functioning. Stock market virtually disappeared. There was no currency market right after the fall. So in de facto, we had imposed capital controls right after the collapse because nobody wanted to trade the Icelandic krona. So there are a lot of small stories to learn from, obviously, but I think if there's only one that I can leave you with is that we know how our system is interconnected. It is a question whether you know how your system is interconnected. And now I am open for questions. So to answer your question, which was along the lines that what happened to the Icelandic people, or how many are unemployed and so on and so forth. The short answer is we had a spike in the unemployment rate reaching 8-9%. It has come down to 4% roughly now. So we have had a history of very low unemployment in Iceland. I mean, most of us have like three or four jobs, like you saw on my profile. But the Iceland has been portrayed, like here in the U.S. media, as a poster child of economic recovery after the crisis. But I have to tell you, unfortunately, that judges haven't ruled on it yet. We have still got the most challenge on our hand, and that is to get rid of the capital controls that were installed right after. So, for example, if you're traveling abroad from Iceland, you can only bring $3,000 or so for your rental car and your hotel and so on and so forth. So it's being sanctioned. Currency is being sanctioned. Net foreign direct investment is at a historic low. Investment in general is very low. So people are seeing their wages have been cut in half in terms of real terms. Even nominal terms have been lowered. Government officials, for example, haven't seen a raise in 8 years. So this is a big chunk of a person's life's work or life's of career. So we are not out of the woods yet. They were primarily the holding company, the loans to holding companies that were just foam, or they were.
Holding companies did more than you think?
Yeah, they did. They held, majority of them held the stocks of the banks themselves, who became bankrupt, and then you had all this domino effect. Most firms in Iceland have become technically bankrupt. That has been the most challenge that we have been faced with after the crash, is to reorganize and restructure the loan portfolios of the banks, because roughly or more than every other loan of the portfolios of the banks were non-performing. That's a very good question on how we kept politics out of the reporting on the failures of the banks. That's your question?
More or less. I mean, we can't do that here. So how did you do it there?
I think that you might see different reactions on part of your politicians if you had your 97% of your banking sector collapse. It's just such a severity of the situation that did not allow for any scrutiny. It may have been, you can wonder about reasons why the politicians, for example, extended this type of data access. I mean, this is unheard of, that the one government that has failed so miserably in their policy making actually brings on themselves an investigation where they can be exposed, and that is exactly what happened. But you gotta applaud this type of behavior on part of the politicians. We're a small society. We were a trusting bunch before the collapse, and one of the guests that I had in the audience at one of the financial institutions pointed out that you need a healthy dose of mistrust in any system, and that was lacking. The mistrust was not enough. But now we swung from the totally trusting system over to a full mistrust. So there was a lot of scrutiny on part of the public. Obviously, we had a revolution, a pots and pans revolution, where people were banging on pots and pans in front of Parliament. So there was not much, room for politicians to sort of, try to cast sand into the eyes of the voting public. In terms of incentives, the question was, what type of prisons do you have where people can, involved in this and found sentenced of guilty verdict, where can they expect themselves to end up? And the one answer is the length of the sentences in Iceland are very short. So as it turned out, we have had one case of insider trading that has been ruled upon, and the person involved has gone to jail for 6 months total. The sentence was 2 years. If you behave well in the prison, you can get your sentence halved, and then you can do a civil service or community service, for half of that, the remaining part. So, for this particular instance, the expected value was positive.
Yeah.
So,
And the conditions themselves are bad?
oh, very nice. You need to be trained to understand acceleration and growth and what it means. You know, lawyers, for example, are not trained in this way. But the explanations need to be sought in the behavioral part. And in small society, there's a big hurdle effect. People were just cheering for those bankers, and you know the government officials and the political leaders were applauding the people who were in charge, and so it took. You basically risked being ridiculed, and I was certainly one of those who had been doing research on credit growth, especially. I pointed it out, you know, a year and a half before the banks failed. And to tell you the truth, there was no reaction to it whatsoever. So that's how that was. Right. So what are the capital controls that are in place, and what are they meant to prevent? So they are meant to prevent a capital outflow of the country. So if there are claims on the bankrupt estates, for one, there are also foreign investors who own ISK-denominated bonds. They want to get rid of their krona and buy foreign exchange for it and leave the economy. And as that is, if people do that massively, you have like a run on the bank situation. So you want to prevent that to happen, because if you allow that, you know, the currency of the krona will devalue, and most of mortgages in Iceland, because we have had a history of high inflation in our economy, they are index linked. So they're linked to the CPI index. So if foreigners leave rapidly the system, the krona devalues, and for example, that of corporates as well as households will increase as a result. So you will have a turbulence, probably non-performing loans, etc. So turbulence in the financial sector. Financial instability is what you are trying to prevent. Does it answer your question? So thank you everybody for showing up here and giving me these great questions to answer, inspiring questions. Thank you so much.